Danielle.
I want to start, obviously, with what's most front of mind for markets these days regarding your company, which is the state of events at Escondida with the strike going on. How far apart are the two sides at this point? And I guess what are the next developments that you would expect or hope to see?
Okay, I'd rather not say too much. A lot of these negotiations are quite confidential. And we have local spokespeople who'll try and keep the media up to date as we think is appropriate. The good news is that we are back around the table and things are starting to come together in some form of a negotiation. Let's wait and see, and others, I'm sure, will update you on the progress of those talks.
Some of the issues that are on the table are ones that other miners are experiencing as well, right? And it all comes from these higher commodity prices that we're seeing. You guys have forecast the market returning to deficit in 2020. Red Kite today, I think, was saying 2017 it could happen. Should workers at Escondida and elsewhere not be entitled to see that reflected in their pay?
The workforce at Escondida is already extremely well paid, and I would be pretty certain that whatever the outcome of the negotiations, they will remain reasonably to high paid. And so I would take some issue with your statement. They already get a lot of the benefits from being part of one of the most successful copper mines. What we're asking them to do is to repair themselves and the way they approach productivity and flexibility, so that as things get tougher, maybe not now, but in years to come, when we are dealing with lower grade, that they still are very investable, and we can continue to guarantee many of the jobs that already exist at Escondida in an appropriate form.
It's clearly a business of ups and downs, and you can see that evidence this year. So much has changed in the last 12 months. One of the pieces of country risk you may have to look at right now actually comes from the United States, and you've been quite vocal about your concern that the changed administration in the U.S. could have an impact on global growth. What specifically do you see U.S. changing policies, the impact being on BHP?
Well, look, I think it's two-sided. On the one side, I think the benefit for business confidence that's come from the Trump administration, based a little bit on what is promised on tax, his desire to cut through some of the politics to get more investment going on in infrastructure, and his general commitment to get growth going again in the United States can only be good for us. We don't sell a lot of product in the United States, but that will add to aggregate demand around the world. On the other hand, we are very anxious about the possibility that instead of that good leadership, we could have bad leadership from the United States on global free trade. Free trade is the lifeblood of the economy. It makes products cheaper for consumers. Consumers buy more, and as a result of that, we see broader economic growth. Long-term economic growth now for the world is probably around 3%. If we're going to continue on the journey to lift people out of poverty, we have to get that to 4%, and that won't happen under a protectionist regime and protectionist leadership from the United States. So some good, but some pretty bloody awful.
You are obviously quite diversified. One of your newest big investments is in Mexico with the development of the Trion oil field. The signing ceremony for that is this year. So CapEx, or this week, is forecast at least $10 billion. How much do you think you can cut that back by?
I can't comment on that, Danielle. I mean, we've just reached final agreement with the Mexican government. I'm going there on Friday to sign the deal. And then we will obviously look at how we can use our best practice and our good relationships with the Mexicans to see how we can make that product more efficient.
Are you relatively confident that there will be cuts that can be made, or that you can speed up the timetable to production?
We're certainly going to try on both counts.
Have efforts to shrink your portfolio been completed, or do you still have smaller kind of marginal assets that it might make sense to sell right now given the run-up in commodity prices? And I guess specifically Cerro Colorado would be one that would spring to mind, but Nickel West?
Our portfolio is close to perfection in our view in terms of its concentration on tier 1 ore bodies and oil and gas fields in the commodities we like. But you're right, there are a small number of operations at the margin that over time we would seek to focus. I won't comment on individual assets, but there is still the possibility for a little bit of divestment. And of course we did conclude some divestments worth around $700 million in the half year we've just reported.
Are there active processes underway for any of those smaller assets to sell them?
Well, we're always open to business. People have a rough idea of some of the things, and in some cases people come to us. In some cases we put feelers out, but I wouldn't like to comment beyond that.
Iron ore and coal have generated a huge share of your first half profits, and yet they're likely to receive far less investment than other areas in coming years. So is that a clue to your priorities as a company going forward?
Broadly, we've said that we would prefer and we see better opportunities to invest in copper and oil going forward, partly because we have those opportunities, partly because these are commodities where there is a natural decline as pressure declines in oil fields or as grade falls in copper, and that production has to be replaced, as well as catering for demand. And that demand, of course, is growing more strongly in the case of copper, as opposed to iron ore and metallurgical coal. Oil is about the same, but it has a steeper decline.